Hi traders, welcome to the Markets in 3 with me, John, Senior Market Analyst here at Anzo Capital. I'm here to give you the latest updates in the FX markets as well. Some key charts to watch and skills that's going to upskill you as a trader. So let's kick it off with the obvious. Dollar yen has dropped significantly. This is something that we've been talking about for so long now. Yesterday in yesterday's stream, I almost gave up on the idea that we would see a move, but I still wanted to try and take advantage of it. And the strategy that we were talking about throughout the past at least 2 weeks was to sell under the end of day lows, just in case we had some kind of move like this one here. And guess what? I did it, but I didn't take as much out of it as I should have. Right, I only ended up getting just over a 1-to-1 return on my risk, and that was because I used the market profile and found a decent level through here that I thought that we might get a little bounce from. But using my experience, I should have known that, and I've talked about it for, like I said, 2 weeks, that the move there is never just 100 pips on an intervention. It's never just 200 pips. It's usually a good 500 pips, and this time it was 584 pips that we saw dollar yen dropping yesterday, and that is down to some intervention in the market. So there's been no necessarily confirmations of interventions yet, but look at that candle. That is an intervention candle. It is 500, 600 pips to the downside. Okay, so the strategy of the week, this week and last week, was, as we were approaching these intervention levels, right, we were looking at shorting below the end of day lows. And I ended up doing it a couple of times. So the first one was back here at the end of June, where I shorted the end of day low here, stop loss above the high, market drops nicely into the 160 spot 60 handle. Great. Took advantage of that one pretty nicely. That wasn't even an intervention though. That was simply the fact that we had the semiconductor and the chip maker stock market, or stocks group, just falling. We had the South Korean stock market, the Kospi, dropping with the likes of Samsung and everyone dropping. So that's what caused this kind of short-term yen strength. After that, throughout July, dollar yen has just been grinding higher, making new higher highs. So as we were going up towards that 164, 164.50 level, which we talked with the October 1968 highs, the likelihood of an intervention grew. The probability that an intervention coming got stronger. So I was looking at basically every bullish end of day candle, I was putting a sell stop order. So every day I've been putting sell stop orders underneath every candlestick low. Now I had one trigger over here, and actually had two trigger. So to tell a lie, I had two trigger. I had the sort of little candle, little kind of inside candle. I put a sell stop order in here, stop loss below the low, but the market kind of dropped, came back. I got out of that position for break even. The market then did the exact same thing. I shorted, I put my stop loss above the high, and the exact same thing happened to me. The market dropped initially, rallied back up, dropped again. It was going sideways. I ended up getting out for break even. The third time, I took the short, stop loss above the high, market dropped within an hour and hit my TP. But like I said, my TP was just over a 1-to-1, which was only 90 pips. So I didn't get what I wanted out of that. Really speaking, and what I'll learn for in the future, and is to take my own advice and say, look, these interventions happen at 300, 400, 500 pips. So maybe I should set up a couple of orders, one to target 300 pips, one to target 500 pips in the future. But anyway, intervention has happened, market has dropped. What can we expect now? Well, we could expect maybe what's happened in the past. So the last time we had suspected intervention, not necessarily, came out with that there was an intervention, was back in April of 2026 when price hit that 160 level, right? And we dropped. the market rebounded, it dropped again ever so slightly, but then since then we grinded from the 156s all the way back up into the 164s. So are we going to see a very similar thing again, where the market drops, grinds higher, drops again, and then grinds back up towards that 164 handle? Potentially. So one to watch is definitely the yen complex. One market in particular that probably would have done pretty well out of this as well was something like a yen cross pair, perhaps a Aussie yen, for instance, because we've seen a lot of stock market drops recently. Aussie yen did drop a little bit. Maybe even CAD yen would have been probably one of the bigger ones, which if we look from the measure of the high to the low of that move, that was about 370 pips there. Euro yen might have been a good one to look out for as well. But the yen complex in general, the yen got stronger overnight and it strengthened aggressively. So that's something to watch out for going into today's trading. Market volatility started to spike a little bit. It's now come back down again. We're starting to see stock markets recover off the back of that. US 500, for instance, back to the upside. And again, that's another strategy we've been talking about in terms of the VIX was too low. The VIX was too low for where price was. We saw the VIX rally. It went above 20. That's usually a signal that a low is forming in the market, and it's formed a low. So we'll see if we can continue to see some upside to the stock market now and whatnot. So the big story, though, in the market is obviously the Japanese yen. It's going to be the chart check today. It's going to be the big story as well. So the reason it's the big story as well is because we've had some data overnight. So if we take a look at the data, it says that the Tokyo Core CPI year on year jumped. So it forecasted to be 1.8%, actually came in at 1.9%, so a jump above expectations there. We then saw BOJ policy rate decision coming in and them holding interest rates at 1%. So if we go take a look, I'm just going to find if there was some commentary on the BOJ, and we can have a little look at that together. So let's have a look at this from News Squawk. It says the BOJ keeps rates unchanged at 1% as expected through 8-1 vote, while it stated that it will consider the timing and the pace of rate hikes while examining the likelihood of realising baseline scenario risks, with one eye impact on Middle East developments. It says that it will continue to raise interest rates in response to economic and price developments as well as financial conditions. Will conduct monetary policy as appropriate from the perspective of sustainably and stably achieving the inflation target. Takata dissented and proposed a 25 basis point hike, which was turned down by a majority vote. Underlying inflation is likely to reach a level consistent with price target between the second half of fiscal 2026 and fiscal 2027. Risks to prices are skewed to the upside. Risks to economic outlook are evenly balanced. Exports and output likely to increase moderately. Recent rally in yen is likely to lead to an increase in prices, mainly of durable goods. The mechanism which wages and price rises moderately in interaction with each other will be maintained. Underlying inflation has been approaching 2%. Financial conditions have been accommodative. Some more analysis down through here. We can see that it says the BOJ kept rates unchanged at 1%, which was widely expected as the central bank had just hiked rates at the last meeting in June. While the decision was made by an 8-1 vote with board member Takata, the dissenter, who proposed a 25 basis point rate hike, but the proposal was turned down by that majority vote. There was little deviation in the language from the central bank, as it stated that it will consider the timing and the pace of rate hikes while examining the likelihood of realising baseline risks, with an eye on the impact of the Middle East developments, and will continue to raise rates in response to economic and price developments, as well as financial conditions. It also reiterated that it will conduct monetary policy as appropriate from the perspective of sustainably and stably achieving the inflation target, and noted that underlying inflation is likely to reach levels consistent with price target between the second half of fiscal 2026 and fiscal 2027. In terms of the outlook report, real GDP forecast for FY26 and FY 2027 was slightly raised, while the core CPI estimate was lowered for FY26, but raised for FY27. So let's see if there's any more information here. Let's see if there's anything more about the US dollar yen. Nothing really apart from that rate statement. Okay, so nothing's necessarily changed from a BOJ point of view. That's why maybe after this little bit of an intervention, it depends on the dollar, because the dollar has weakened significantly as well now because of the FOMC this week. But if we were to see kind of, the potential of a dollar weaker, then maybe dollar yen can continue a little bit lower. But we have to consider the fact that the yield spreads are still wide, and the fact that that can create still that nice sort of carry trade, right? Lost my words there of a carry trade. So yeah, dollar yen downside could continue. We usually get a second leg lower after the intervention, so just keep that in mind. Like I said before, with the dollar a little bit weaker as well, there could be a good shout for this to continue to the downside a little bit. I will be just watching those 4-hour highs. I think if the 4-hour highs continue to reject, if let's say we get a little bit of a higher high, higher low situation, and if we get like a lower high coming in, I will look for another short on dollar yen in the meantime. But there is that risk that we can see dollar yen back towards that 164 handle in the future. So let's move on to the final part of today's session. And the title of our stream today, which is how to use seasonal patterns to predict Forex trades and Forex moves. And it's really, really easy. There's a couple of ways that we can do it. So I'm going to show you the free way to do it, and I'm going to show you the sort of a little bit more of a paid version of it, right? So we're going to go to something called Equity Clock, and I'm going to drop these links in the chat so that if you want to look at it as well, you can do so on your own time. So the first one I'm going to drop in is something called Equity Clock. Now, Equity Clock is a seasonality platform. And why is seasonality so powerful? Well, it's because there are cyclical parts to a market, okay? Whether that be, VAT cycles, whether that be tax cycles, whether that be earnings reports, whether that be, FOMC interest rate decisions and stuff like that. There's all elements of seasonality with it. You've got presidential elections, presidential midterms, which we've got this year, and all that kind of stuff. So there's lots of different things where seasonality can come and actually help find us some trade ideas. Now, Equity Clock is a free version. If you come to this website, you can go to charts, and you've got a list of all the things that you can look at. So there's a few things. So let's say you even want to try and predict employment, right? You want to predict what NFP is going to be doing in the next NFP. Well, you can come to the seasonality chart of non-farm payrolls, right? And what we can see here is total non-farm payrolls seasonality, right? And what you'll notice is that the 2026 year has followed in line with seasonal patterns, right? We typically see a strong decline in January jobs numbers, right? So that's technically that's December's job numbers. Then we have, February is a bit sideways, and then we see this jump in the NFP reports, right? All the way up until June. So guess what? We're in July. July's numbers, what are they going to come out? Well, technically, over a 20-year history of NFP, July is usually pretty poor numbers, right? So on August the 7th, we actually could see a drop in the jobs data, right? Potentially. and then we usually see a little bit of an incline for the rest of the year. So it's really interesting to see that, because obviously with the situation at the moment in the markets where dollar's under a bit of pressure, we're getting weaker inflation data, could that lead to weaker employment figures? Potentially, right? So we've got all other things in here as well. You've got Forex futures, currency futures, interest futures. So you've got the 2-year bond notes futures. You've got the S&P. So let's say you want to look at the index futures at the S&P 500, and you want to pick out an area where we usually see a significant low. Well, look at this. Usually in June, end of June, we get a low, and the market can go on a little bit of a rally through to the end of July. Now, if we actually look at what's happened to the S&P 500 this year, that's not been the case, right? And this is why I'm going to show you a different version of using this. Well, technically, if you bought on the 30th of June, you would have made probably a little bit of money. We made a move from 7,486 up to 7,578 before seeing a complete reversal to the end of July, with prices coming in lower. So I'm going to show you something else. This is a seasonal chart that I use all the time, a seasonal software. It's called Markets Made Clear, and it gives us some really important information. So if we go to the dashboard here, we have our seasonality dashboard. We have everything from cryptos, Forex major currency pairs, cross pairs, indexes, US sectors, US stocks, UK stocks, Australia stocks, European stocks, financial sectors, energy sectors, metals. We have so much information here, right? Same as equity clock, but it's just styled in a different way that's really helpful. So let's have a little look. Let's have a look at the S&P 500, right? So I'm just going to put in the E-mini S&P 500 stock index. Okay, that's the futures contract, right? Now, what I love about this is the fact that like equity clock, we have a seasonal average, which is that 20-year seasonal average. It shows the low that forms at the end of June and the rally that happens to the end of July. It gives us that there. But what I can see is that the current years, and this is where I think Markets Made Clear really differs and really gives you an insight, is the fact that our current trading year only has a 0% correlation with the 20-year average, right? 0%. So that tells me that maybe this year we won't get that seasonal run, because we have a 0% correlation over that 20 years, right? Let's look at a midterm election year, right? Only has a 1% correlation with price. So again, nothing on the midterm year. What I love, though, it has this feature called True Path, and I think this is an amazing feature that Ray at Markets Made Clear has built in. If you click Calculate, what it does is it calculates all the years that we've had a similar trading pattern to the one that we've had this year. Okay, let me see if it comes onto the screen. Might need to refresh the page. Let me refresh the page. Let me come back, right. Here, calculate. Either I'm hitting calculate and it's not working, or there is no years that match this year. So that's probably not a good example then. Let's move on to a different one. But you can have a little look and play around with the years and how many years are similar, you know, to this. You can have a look at what's called the weighted average and have a look at the correlation between the years and stuff like that. And I think it's great to doing that. Let me just move on to a different one. Let's see if there's a different one that we can have a little look at. Let's say Google, for instance. Right, we can see that typically, you know, we have a decent sort of run up in Google between the end of June and July. That's not happened this year. We've actually had a bear sort of Google from sort of May all the way down to July. So let's see if I click True Path. Let's see if it does anything. No, there must be something in the system at the moment where it's not allowing to click True Path. But yeah, well, I'll have to have a little look at that. But basically what True Path would do, it would kind of select all the ones that are really good and then go from there. So let's show you a good example of this. If I go to the British pound futures, right, we can see that we have over all years a 25% pattern. Over 20 years we have a 20% pattern, right? But at the start of the year, on the 20-year correlation, we had a really strong correlation between January, April, and May. We actually had a pretty strong correlation between the 20-year seasonal average and the current year's price. Usually at the end of April, we see a bottom form, and that's exactly what we had this year. And that can give you an idea of a potential trade, right? If you see that the 20-year average and the current year are having very similar years, then that can show you, and it has a strong correlation, that can show you a potential trading opportunity that you can take. And that's why I love seasonal analysis, because you might be struggling to find trade ideas and things like that, and then you see something like this that just helps cement an idea. Now, it has to be used in context with everything else that we talk about here on the channel, whether that's macro, currency strength and weakness, and all that kind of good stuff, maybe even sentiment from the commitment of traders. You have to combine it all together, but when you do, it can give you some real strong analysis, okay? It's working on the pound, right? Let me show you TruePath, because I think this is just an amazing feature. So TruePath picks out all the years that is having a similar year to this in British pound sterling, and only 2 years, 1993, the year I was born, and 1991 matched the current year with what pound's doing on a 55% ratio. And look, it matched it perfectly. It said that there'd be a low form at the end of March, start of April, and rally, and it did. It says that there would be a bearish period from the 2nd of June to the 19th of June, and it did. It said it'd be bullish from July 8th up until sort of September 10th, and it's been bullish. So it's had actually a pretty strong seasonal pattern with those 2 years. So that's interesting to see. So yeah, that's how you can use seasonal patterns to predict Forex market moves. I'm going to leave it there. I'll speak to you guys next week. Hope you have a great weekend. My name's John, Senior Market Analyst here at Anzo Capital. If you do want to follow us on YouTube, hit that subscribe button. It means a lot to us. It shows that you enjoy this type of content and that you've learned something new. If you want to go to our free Telegram channel, here is the QR code to do that. Hit that QR code. You can join me every day in there, talking all things markets, from news, charts to watch, strength and weakness in currencies, and seasonal patterns I apply there. So if you want to do that, you can. Also, you can go to our Anzo website and see all our educational content there, including things like blogs and market analysis. So thank you for watching today. Really appreciate it. If you enjoyed it, leave it a thumbs up, subscribe if you are new around here, and I will speak to you soon.